All right, guys, we are back. We are ready to get started with stock maturation. This is really eye-opening section. Make sure you take any questions you have, write down the page numbers. We'll come back to them during the Q&A session. Quick reminder, tonight replay will be 6 p.m. Eastern time. And this section on page 39, I believe will take pretty close to about 45, 50 minutes. So let's get started. Then we will have a 15-minute break after this section. Back to Mark.
Okay, we're back. I just want to recap. We talked about categories, right? Talked about the various categories, the market leader, the top competitor, the institutional favorite, the turnaround situation, and we put that into perspective on the various categories that you want to categorize a company first. The specifics of why and how we're going to apply tactics to each category, mainly in fundamentals. That's where really you've got to use different tactics in different categories. We're going to get into later. Okay, so we'll get there. Valuation. Basically, what we do is we dispelled the PE ratio as being very valuable as any type of timing tool or even a valuation tool. It's not a very good valuation tool. It does tell you whether a stock is cheap or expensive at the time, but it doesn't tell you anything about the future and where the stock's going. As a matter of fact, I would prefer to have a stock that had an above a PE that was above the market average. So let's say the S&P is trading at 20 times earnings. I'd much rather have a PE that's double the S&P trading at 40 times earnings than half of the S&P trading at 15 or 10. And certainly if it's trading at 4 or 5 times earnings, that tells me that something's wrong. It's just, being that cheap. So when you get below the S&P 500, the more you get below that, the more it's telling you that something's wrong and the future may not be so bright. When you're above it, it's telling you that there's a high expectation for the future. Now you just have to see if they're delivering. That's the main thing, to make sure the stock and the earnings and the fundamentals are delivering. But what we want to talk about now, and going back to where I said that the 95% club, the very first thing that I do when I'm looking for a potential stock to buy is I apply what I call non-negotiable criteria. This is what I would refer to as my qualifier. If it doesn't meet this criteria that I'm going to show you in just a second, then I don't even consider the stock. So this narrows my universe way down. This chops out a lot of the stocks that are going to be names that I don't want to waste my time on. And this is going to narrow down your list to a more manageable number of names. Now, the reason behind this, again, everything that we're doing here is not just something just came off the top of our head. This is all based on many, many decades of not only my own experience and anecdotal evidence and scientific evidence in real time, but also looking and factor modeling and going all the way back to the 1800s to see that the same thing was happening, when Coca-Cola in the early 1900s to Monster Beverage, in 2000 change. Nothing's changed. Nothing's changed with regard to earnings, sales, margins, your trend, momentum, alpha. Nothing's changed. So stocks will go through these 4 phases, and of course, my good friend Stan Weinstein is sort of the grandfather of this. I read Stan's book back in the 80s, and I was fortunate to meet Stan in 1990 in New York City. As a matter of fact, just a couple months ago, I think it was last month actually, I had dinner with Stan and his wife, and he always loves to talk about stocks and stage cycles and so forth. Great, wonderful man who's made an incredible contribution to trading and teaching traders. And so this cycle work is so important because this is the very first thing that you need to get right, or everything else is a moot point. Now, if you start looking at base breakouts and all the stuff that I'm about to show you later on, and you apply it to a stock that's in a downtrend, you're gonna be you're gonna have very poor results. All right, it's not going to work.
Mark, I want to add too. I think it's really important. You alluded to that everything here is based on timeless principles. this and works on really every time frame as well, that I often tell folks. People ask me, what's the content like? Everything here is timeless. If you go back and look at some of these charts from 100 years ago when Jesse Livermore was trading, or even earlier, I've looked at charts back in the 1800s. You see these same 4 stages. You see these same patterns continuing to set up and take place. So you don't have to worry about, well, what happens if this falls out of favor? Because it's not going to fall out of favor, at least permanently, because again, it's based on really solid, timeless principles.
Yes, absolutely. You're gonna, and we go back to, again, where I talked about how, putting the probabilities, in your corner. 98% of every big winning stock in the last 100 years, going back to the start of the stock market, it was in a stage, what I call a stage 2 uptrend, which I'm going to give you the criteria. 98% before they made their big move. So my question is, knowing that there's a 98% chance of being in the big winner if you're in the stage 2 uptrend, above the 200-day moving average, the 200-day in an uptrend, and a 2% probability of having the big winner if you're not, which club would you like to be in? You want to be in the 98% club, or you want to be in the 2% club? So knowing that, if you buy that's true, and this is fact, this is an opinion, this is fact that we're presenting. Who would ever want to have a 2% probability versus a 98% probability? So why would you be buying a stock that's down and broken? Now, can stocks that are down go up and are in downtrends? Absolutely. But I'm going to show you why it's a bad idea, and that's going to unfold as we go here beyond this section. Again, this is the perspective section. But now, what you're not only losing price. Let's just say that you buy a stock down and it doesn't go much lower. It doesn't turn into a disaster. You don't lose any money. Well, but you're losing time. They're losing time. When you go through these basing phases, so you're going through stage 1, stage 3, and that's what we break this down into. We break it down into 4 stages. Stage 1 is the basing phase. Stage 2 is the advancing phase. Stage 3 is the topping phase, and stage 4 is the declining phase. This is, like Mark said, timeless. You're going to go through these 4 phases, some faster than others. Some you're going to have where they go from stage 1, stage 2, back into stage 1. They rebase and they go back into stage 2 again. But you're going to go through this. What you want is you want to be gaining value as fast as possible. Okay, that's the goal. The main goal is to be not only gaining value, but doing it as fast as you can. Because again, if I can make 20% in 3 days, and I can do that a couple times, well, I just accomplished 100% return in a very short period of time, where you may buy a stock and you get that same 100%, but it takes 2 years. I'm going to make much more money than you. And that's how I make the big returns, because I not only know how to get the stocks that move, but they move quickly. Okay, so that's also part of it. Let me show you some.
Just look at this chart real quick too, Mark. I think it's a great example of, to any man's eye, where do you want to be playing? And you have a tremendous advantage over other players who either don't have this knowledge, don't have the discipline to follow it, or are mandated to be in stocks and hold them through these gigantic, periods where just nothing is happening. Where in stage 2 here is where all the alpha is. That's where all the excitement is. And that's where you want to be playing. Ironically, I traded this name. I remember Weight Watchers really well. They had an announcement or something like that. The stock went into a new stage 2 and had a great move. But once you got off it, it went nowhere for years.
Yeah, I don't remember if this was the particular time, but Oprah had bought a big.
That's right.
Amount of shares. Yeah, the Oprah effect. So another thing that's important to mention here is that stage analysis is not a strategy. Okay, it's not a strategy in itself. And Stan Weinstein himself, who wrote a whole book on this, would tell you the same. I talked to Stan Weinstein like on a weekly basis. I talk to him at least every month. So I know Stan really well. We have dinner together. We talk about this stuff all the time. So I can tell you right now that he would tell you that it's not a complete strategy, just stage analysis in itself. There's more to it than just that. But this is the starting point. And Stan would never be buying a stock that in a stage 3 or stage 4 or stage 1. He's going to be buying in a stage 2, just like myself, just like Mark. Let's look at some examples. Weight Watchers, of course, lumber liquidators, like we talked about before. Here's another thing I want to point out. You're going to see a lot of times I'm going to show you the same stock. And the reason why is that we're going to build on it. I'm going to show you it in the stages. Then later on, I'm going to show you the base breakout that came from the point where I was buying it. And I'm going to show you the fundamentals that were in another section to that same name. And I'm going to show you when it topped. So you may see some of the same names over and over, but we'll be building. We'll be building on the information and building. And so at the end of this, you have a complete picture. And it's like all these pieces of the puzzle are going to come together. Okay. So again, stage 1, stage 2, you see, this is, as Mark said, this is where all the excitement is. This is where all the gain is in the shortest period of time. Then you go into a quick stage 3, you top, and you're in a stage 4. Now, if you were to look at put some moving averages here, you're going to see that, and I'm not sure, let me just see. Do I have the examples? Yeah, okay, we're going to get to that in just a second. You're going to see that you're going to be above the 200-day moving average, and the 200-day is going to be an uptrend during the stage 2. In the stage 3, you're going to flatten out. You're going to be whipping back and forth, and it's going to be more volatile. In stage 4, you'll have a mirror effect of the stage 2, where you'll be below the 200-day, and the 200-day will be in a downtrend. Also, going back to Stan, because in Stan's book, and everybody should read Stan, if you're interested in stage analysis, you should read Stan Weinstein's book. He has switched over. He started with the 30-week moving average when he first wrote the book, and he has since switched over to the 200-day. I use the 200-day. You can use the 30-week. It's pretty effective as well. But again, he has, and I don't even know when he made that switch, but he does use the 200-day now, just as a note. Crocs, very short stage 3. It topped very quickly on an earnings report and just got blasted. But again, you can see here, you don't want to be involved here. Stage 1, you're losing time. Stage 3, you're losing time. Stage 4, you're losing money and time. Stage 2, you're gaining value and fast. And that's what the only place you want to be. Okay, that's the key of all this, is we want to convince you that you only want to be in this one stage. Now, this is a stock. This is Lulu. This is where I was buying Lulu, right here. You see, you're already in a stage 2. I'm not trying to guess or play it in stage 1 or stage 4. We're already in a stage 2, and it starts breaking out. You see it accelerates very quickly. That's what I want to get at a profit as quickly as possible. Now, here in stage 3, what will happen is very often, just like I'm going to go back here and show you Crocs. See this big break here? That's institutions. That's, as O'Neill used to say, I don't know if he said Betty or he said Sue, but someone's aunt. That's not Aunt Betty selling there. That's not Aunt Betty with all this volume and this price. Those are big institutions. You go back, you look at Facebook right now, you'll see the same thing. It just broke just recently for a second time. Those are institutions unwinding these positions that were built up through stage 2, all the way up, and you've got these big profits. And now you've got all this ownership. They become institutional favorites. They become quality companies, like we talked about. See how everything's chronological here. Everything that I tell you, another point I got to make real quick, I forgot to say this, but everything that I tell you previous is never negated by anything I tell you afterwards. So we are going to build upon everything that I tell you is just a step in a staircase. So we're going to keep building upon it. And so just keep that in mind.
I just want to point out too, Mark, if you look at this chart, and this is a classic textbook example, and I remember this Crocs chart from the first Master Trader program, that break on volume, biggest decline, biggest volume, I think it might have even been at the time in the history of the stock. I don't remember.
It was.
But we just, to your point, we have been in an environment, when a stock does that, it is signaling, to your point, there are major, huge sellers that are taking profits and getting out. And we've seen this now literally in the last 3 to 6 months, how many stocks have done exactly this. And you've seen how many people on Wall Street saying, oh, they're a great buy here. And all of them have gone lower.
Yeah, absolutely.
All of them. almost 100% of them have gone lower because the institutions are what is driving this. And this is one of the things Mark and David Ryan, looking at volume, it is obvious that is elephants piling out of the tub, which means the water level is going to go lower. And every time I'm shocked at the number of people that continue to say, oh, it's a great buy down here.
Amateurs love to buy on big breaks like this. They'll buy Facebook, they'll buy Amazon, they'll buy Microsoft, Google on a big break like this. That's why they're amateurs. Pros are selling here. That's what this is representing. And sometimes you get some bounces, you get some oversold bounces, but these are big sell signals. That's you're entering that stage 4. And what I was pointing out before was when you're in stage 3, at some point to really understand whether if you're heading into stage 4 or how certain you can be that you're in the stage 3 and you're topping, is you'll start to see these large breaks. And sometimes the stock doesn't break yet, doesn't fully break. It even rallies back and it takes more time. Sometimes you get that first break and it takes a year before it actually tops, but you lose a lot of time and you don't really get anywhere. And there's a lot of volatility. And then finally it breaks again and it starts gapping and it unravels. So again, differentiating and knowing when you're in stage 1, 2, 3, or 4, what's really important is I'm not too concerned whether I'm in 1, 3, or 4. I just want to know how to identify stage 2. I always tell people, you don't have to know all the things not to do. You just need to know the things to do. There's only a few things that you need to do, but there's millions of things not to do. So don't overcomplicate it and try to figure out what does a stage 3 look like. As long as it's in stage 2, that's what you're concerned with. Anything other than stage 2 criteria is one of the other 3 stages. All right. So we take a look at some of these names. TDOC, this was one that was a leader, made a big move. Everybody loved it. Now you're in stage 4. You don't need moving averages. You don't need anything to see this. It's very obvious. You can also see that this left side is characterized by lots of blue. Those are up weeks, and this is a weekly, it's weekly, up weeks, right, on volume and blue. And then look at all the red volume, the red bars. That's all down. You just see the contrast between the two, right?
Mark, if you look at that too, just to point that out, perfect example of how you get those large, big red bars as it's going into stage 3. There's none of that when it's in the stage 2, except for maybe one bar. But up there at the top, as it's topping, again, those are institutions that are selling and putting in the top.
Zoom, another one. Another favorite there. These were short-lived favorites. These are more flash in the pan. Like you go back to 1988, 89, LA Gear. LA Gear was a stock that I held for a 400% move, and then it just got clobbered and unraveled. But it was a fad. And really all they did was they put glitter in the laces. They had colored laces and glitter in the laces. Nobody had ever done that before in these sneakers. And it was probably a little more than that, but that was the main thing that I saw. The kids were wearing them, and I called around. There was Foot Lockers at the time in malls. I called a bunch of Foot Lockers. I said, hey, are these LA Gear shoes, are they selling really well? Guy said to me, man, if I had 50 cases of them, I couldn't keep them. They're selling so fast. I called California and I asked a few places out there, how the LA Gear sneakers selling. They're like, oh, the hottest thing, and the stock was breaking out of the base. The earnings were triple digit earnings over the previous 3 or 4 quarters. I bought the stock. Matter of fact, I told my uncle Benny, who loved the stock market, he actually got me interested in it somewhat. And I gave him the stock, and the stock went up 400% from there. I was a big hero with my uncle. Unfortunately, he held it all the way down. I sold it. Anyway, that's a whole nother story. So I'm going to be interested in a stock after it's coming out of the stage 1. It's getting into the stage 2, and you can see I'm not the only one. If you take a look at the volume here, look at the contrast in volume. You see the volume here that's relatively low, and then when it starts getting at the stage 2, look at how the volume on average is much higher. That's institutions. That's what you want. You want to be riding the backs of the institutions. Here's the key, though, and this is another thing that I probably should have told you up front, but I'm going to give you the techniques, the same tactics and techniques that the institutions use. The difference is that you don't have to buy 1 million shares. You don't have to go to an approval board. You don't have to have analysts make all these big glossy bound reports and make this big case and bring it before your board and get it approved, and then go buy all these shares that represent this big giant position that still doesn't even represent a very big position of the fund. Even if it doubles or triples, it doesn't even have a big impact because they can only take so much size because of risk and so forth, and report to shareholders and all these things. Think of that as a big cruise ship that can only move so fast and turn around very slowly, and you're in a speedboat. You're in a speedboat. You can move quickly and you can turn around in a second. You can sell, you can buy, and your speed and your agility makes you superior to even information superiority. Even the funds that have analysts, people go, well, I can't compete with the pros. They've got armies of analysts, and they go to the company and talk to the suppliers and the vendors, and they know everything about the company. Yes, that's true. They have to, because they've got to make this big giant case, because they can't get out. They can't get in very easily, and they can't get out very easily. So they've got to make certain that, as certain as they can, that if something goes wrong, they know what's going on in that company, and it still doesn't work. It still doesn't work because things can change very quickly in business. Conditions can change. The economy can change. A war can break out, and you have the advantage of being relatively small. Even if you have a $10 million portfolio, which is probably more than most people in the world, it's still very small. It's very small. Anyway, let's move on.
This is an extremely important point, Mark. I just have to jump on, though. And the idea being, because you hear all the time that, well, things are disadvantaged for the little guy. And I just think it couldn't be further from the truth. That's my own story, by the way. So I'm telling you my own story. I started small, and there's no question. Especially armed with the information you're getting here. But if the analogy I often give people is, if we're playing chess and there are moves that I can make that you cannot make, who has the advantage?
Right.
Me.
Right.
And that's precisely, there are moves you can make, cash, and the ability, like Mark said, in some cases you're riding a jet ski, off their wake, off these institutions, is a tremendous advantage, over them. And I just can't stress that enough. The individual has a huge advantage in this game, but you have to, again, be using good criteria, discipline, and all the things that we're going to be talking about over the next,
Yes,
days.
you still have to you have to be able to maneuver that boat and drive it, because with speed and agility comes risk also. And I was fortunate to understand this a long time ago. Now, I didn't have the skill to take advantage of it or apply it. I did understand that there was a big advantage to being small. I did not know how to take advantage of it, though, for years. It took me almost a decade before I realized how to drive that speedboat and to maneuver it properly. But once I did, it was lights out. The rest was history, and it changed my life. So again, let me show you. So very smart people still make very big mistakes. They just make bigger mistakes. And very often they make it with other people's money. That's another thing. Here's a Valiant Pharmaceutical. If you remember, this is a very, most of you, I won't have to mention the name of the big investor, the big hedge fund manager that was buying this, all the way down pretty much. And again, this would be completely off my radar. If it's not above the 200-day moving average, well, I'm not even going to look at it. So before it even went into that big nosedive, you shouldn't even be considering this stock. And that simple rule right there, I think, Mark, you were talking to me about, if in the recent market, what would have saved people tons of money if they just followed one rule. Looking back now in hindsight of all these stocks that are down so big off their highs.
This one right here, or just the simple rule of avoid anything that's not in a stage 2. And Mark and I were talking about this offline, and I was speaking with a friend of mine who attended last year's Master Trader program, and he basically said, if I had only listened, to this rule in terms of just avoiding names that are trading below their 200-day or aren't in stage twos, it would have saved me so much money. And look, a bull market, eventually gets enough people lazy and they think, to Mark's point, we made in an earlier section, though, I guess these stocks can't fall or they can't have long downtrends. And all that is nonsense. These stocks at the end of the day are pieces of paper, and they can absolutely go to zero. Regardless of how good the company is now, and we're going to show more examples, but this past 12 months has been a really, really good lesson for a lot of newbies and, sort of amateur type traders. You can't learn this fast enough, in my opinion. You have to get this. The idea of non-negotiable means it's non-negotiable. So when we get questions all the time, what do you think of XYZ stock? And usually we've never heard of it. We already know it's probably trading below the 200, so we haven't even seen it. And our process is, set up in such a way that we're not even going to see a Valiant when it loses 90% of its value most of the time.
That's right. And again, you may get stocks that can go up, from downtrends. However, what you're going to guarantee yourself, if you're buying stocks in downtrends that are below the 200, that are in stage 4, you're going to guarantee yourself to be in the big giant losers. And if you're buying the stocks that are in uptrends, you're going to guarantee yourself to be in the big winners at some point, because that's where they make the big move. Now, going back to Mark, we started this all off, and he just said non-negotiable, why it's non-negotiable. We started this off talking about non-negotiable criteria. See, this is criteria that is absolutely, some things that we're going to talk about, there's some gray areas, and it's going to take, there's subjective things that have to be judged, and your expertise and your skill level is going to come into play. There's other things that are lines in the sand. They're hard lines in the sand. It's black or white. This is one of them. This is one of the black or white. It's either in an uptrend and it meets the criteria, or it's not. And if it doesn't, then we're going to stay away from it. All right. Let me show you a few other examples here. And again, you can see right here, I just pointed out the characteristics that of an uptrend are going to be where you have big volume on the upside, pullbacks are on lighter volume, and when the stock is selling off and you're getting those institutions are now piling out of the stock, you're going to see the exact opposite picture, where you see the big volume comes in, and then as it stabilizes and rallies, the low volume, and then the big break, and here comes the volume again. See, those are big institutions unloading. So if you believe in this, institutions are so superior and they have this great information, well, why would you ever buy a stock that they're unloading like this in mass? Anyway, let's move on. So back in around the 2007, going into the 2008, the subprime, the big debacle, the banking system and so forth, the financial system was in a very bad shape then. We had a brutal bear market. So many people got caught in the banking stocks and got caught in these financial stocks, and like recently, they thought they were safe in a Citigroup, like someone thought they were safe in a Facebook, but you had such ample warning. Like, so many people said that this came out of nowhere. I got caught in this big decline, when actually the writing was so on the wall. But a couple of things I want to point out. One is that you can go from a stage 1, and then you can start morphing into stage 2 and not really get into a stage 2. All right. To really get into a stage 2, you not only have to get up where you're above the 200-day moving average. And again, I'm going to give you the criteria. Some of you already know the criteria. It's in my book. This is no big secret here, but it is the starting point. To get that stage 2, you want to get into the uptrend and then a pullback, and then stair step yourself higher, which this never happened here. And sometimes you'll go from stage 1 right into stage 4. Which you can look back and maybe in hindsight, it looks more like a stage 3 if there's a previous advance, maybe not, maybe it's already down a bit and it goes even lower. But the bottom line is you didn't transition. See, this was Citigroup, and it failed to transition. It started turning up here, and it came out of a really nice big base. This is looking like a buy right here, but now you've got to change when the stock changes direction, you've got to change direction. Now, I often say, the stock market, the stocks are an engine, and I'm the caboose. It's like a train. I just follow. I follow where the engine goes. I'm not trying to predict. Well, here you come off. You're only off if you bought this breaking out here. Even if you paid up for it and you bought up around 55, you're down maybe 10% or so, 8 or 10% here. You don't have a very big loss, and it breaks. It's clearly in a stage 4. and look at this stock. Some of these stocks, AIG, they went to zero. Now, these were, again, Citigroup, Bank America. Now, here's where one that Bank America is in stage one, is in stage two. This is a confirmed stage two, but very short-lived. It very quickly morphs into stage three and then breaks down into stage four. Again, these are the points at which if you had bought this stock, you certainly would want to be selling at these key points as you're taking out these lows and you're below the 200. If you didn't sell in one piece and have a stop loss, you certainly, as this is worsening, you're cutting back your exposure until you get into cash here. Now, some stocks will go from stage 2 to stage 3 or 4, and they become shorts. We're not going to talk about shorting anytime during this whole seminar, workshop. Are we going to get into shorting? The reason why, okay, is because number one, I'm not that great at shorting. Okay, I would say that, you know, if I were to grade myself on shorting, it's not my best my best attribute in trading, because quite frankly, I don't do much of it, and there hasn't been the opportunities. When you go back and you look at history, bull markets are much longer than bear markets. There's a lot of more risk with shorting. There's limited upside, which is downside with shorting. A stock can only go down 100%. Amazon went up 80,000%. So you don't have that opportunity. And recently with Reddit and all these crazy things where you get rumors and stocks can gap up, the losses could be astronomical. But the real reason is because what I found is it's unnecessary. It's just not necessary. There's so much opportunity on the long side that you don't really need the short side. However, we do recommend to our clients sometimes some shorts, and there's opportunistic shorts, and sometimes a stock that was previously in a stage 2 and I either bought or I recommended or both turns into a short. And so, and this was a real life example. I bought this ANAB coming out here. You can see it's in a very strong uptrend. I sold it here, pretty quick, quick capture of a move. Way later, after it goes into stage 4, I'm actually adding it to our short list right here. And then you see you get the big break later on. But so this is where you go through that maturation cycle. And yes, you can play various parts of the cycle. The two parts of the cycle, if you want to call it the head and the tail, would be the stage 2 uptrend for longs, the stage 4 for shorting. The areas that you want to avoid at all costs are stage 1 and 3, because that's where you don't win on either side. They just move back and forth. Unless you're a real short-term trader, you're going to get whipped all over the place. So stage 1 and 3, you got to be really careful in. That's why if you can identify 2 and 4, 4 you completely stay away from, 2 you want to be in, the other 2 kind of surface on their own. You sort of see the contrast there. You can Amgen, I'm sorry, I'm on Amazon. Amgen back in the 90s had a very strong stage 2 uptrend, went into stage 3, and then it reasserted itself and went into another stage 2. That can happen. Just because a stock goes into stage 4 doesn't mean it's over forever. You can go through a stage 1 and rebase, but what normally happens is when you get into a bona fide stage 4 and you have a big break in the stock, it'll usually be a number of years before you get back into a stage 2. Usually it's 2 to 5 years minimum, and sometimes decades, sometimes 10, 15, 20 years. Now, the other thing you'll find is a lot of times when you get a stock that breaks, all of a sudden you'll have analysts and brokerage houses, and you'll get Morgan Stanley put it on their buy list. It's undervalued. This is where you got to just ignore this stuff. All right, upgrades and all this stuff that you get from it. This is what we're going to show you on how to think for yourself, and you won't have to rely upon any of this crap anymore. That if you went back and you looked at analyst upgrades and downgrades, you'd be amazed at how horribly wrong they are. This is just an example of a stock that we put on short alert. After it was stage 3, it started breaking and it looked like it was entering into stage 4, had a little rally, and right here, Citigroup upgraded it to a buy. 3 days later, the stock implodes down 23%, and you're in a clear stage 4. And then, more buys came in. It was undervalued. This was Chipotle. Again, stock was growing. Now it breaks. They're looking in the rearview mirror, looking at the growth rate, and now with the stock down, it looks like a value. No, the stock's discounting. And you see here, look, breaks again, big break here. This is all the big selling coming in. So you're going to see the same thing. This is something serial gapper. We call them. Once you go into a downtrend, what you'll see is you'll get a lot of unhappy surprises. You get a lot of downside gaps. This was when Coors topped. When it broke the 200-day, closed below it, we put it on the short alert list, and look at all the gaps. And this is what I gotta give David Ryan credit, because this is his term. He called them serial gappers one year, a long time ago, 6 or 7 years ago, in the Master Trader Program, and I've been using it ever since. This is where you want to be aware of these serial gappers, and when you're in a downtrend, you're in a stage 4. That's where you're going to get the serial gappers. In the stage 2, you're going to have the opposite. You're going to get those happy surprises. Okay. All right. So we're gonna wrap this up. Also, I see we didn't put it in earlier, but every year at the Master Trader Program, and I know Mark just alluded to that. By the way, just want to let you know your name is Trisha, and we got to change that. I think you're on your wife's.
I am.
He's not Trisha. It's Mark. It truly is Mark Ritchie, but his wife is anyway. So this little gold nugget here, I think we added it on some of the slides going forward, because Bob Weissman, who moderated the in-person Master Trader Program for a decade, from the very first one, if you remember, Mark, he'd say golden nugget. When I start to talk about something that he thought was really important, he would say, everybody, golden nugget, golden nugget. And it turned out to almost be a joke as we went on throughout the years. But we put in some golden nuggets here to show you some of the areas that we think are very important, that we're talking about here. Why do we want to trade with the trend? The saying is, the trend is your friend, right? And what we're talking about is a stage 2 uptrend, which the next slide gives you that criteria, and I'll talk about it with you in just a second. One, it's going to increase the probability of your success, of finding a stock that has the potential to make a big move, because 98% of big winning stocks started their big move after they were in a stage 2 uptrend. So right there, you're shifting yourself to the 98% club, right? You don't want to be in the 2% club. It's giving you evidence that institutions are buying. And I'm going to show you later on why it's so important that we want institutions in the stock up front. Before we get in, we want the institutions already coming into the. We're not trying to predict when they come in. We want to already see that. And I'm going to show you there's a real important reason why, a supply-demand reason why, something that you won't expect of what I'm going to show you. But here's the real reason that everything that we talk about through this entire workshop, the reason why we're doing all this, yes, it works. It's been proven. We've used it for decades. We've looked at it and factor modeled it back. If you want to call it back testing, we don't back test, but we've looked at factor modeling and looking at the biggest winning stocks. The real reason is because it creates reference points. What it does is that we don't know. There's a lot of scenarios that can take place where a stock is in a downtrend and it has a PE of 5 and it's oversold and all these things that I have no idea what the stock's going to do under those conditions, or what it's supposed to do. Like, what would be normal? What would be abnormal? But when a stock is in an uptrend and it's coming out of a particular set of circumstances, out of a base, out of the things you're going to learn from me, I know exactly what it should do and what it shouldn't do. And that's all I need to know. Once I know what's normal and what's abnormal, I know if I should be buying it and adding to it, or if I should be cutting back and selling it. All right. And that goes back to Jesse Livermore. If you go read Jesse Livermore, that little thin book, How to Trade in Stocks by Jesse Livermore, which I love. He talks about don't be afraid of normal price action, but be very afraid of abnormal. You have to know what normal and abnormal is. And I've told this story. Some of you might have heard this, of course, if you came to the Master Trader Program before, but I would be remiss not to tell it again for those of you that are new. If you're taking the 605 every day, you're in Connecticut and you're taking it to New York City each morning to go to work, and you're sitting on the platform waiting for the train to come in. You look at your watch, it doesn't come in, it's 6:15, it's 6:20. what would you think? Well, it's late, right? The train's late, probably be here any minute. Okay, now you look at your watch, it's 6:45, it's 6:50. The longer it goes past 6:05, the higher the probability that something serious is wrong. I mean, if it's 3 hours later, it's not just late. Something is really, really wrong. Why? How do you know that? How could you know that the time that elapses is increasing the probability that something is wrong? Because it's supposed to come in at 6:05. See, if you didn't know that it was supposed to come in at 6:05, it wouldn't be meaningless. If at 7:50, it wouldn't matter. Nothing would matter. You have no reference point. So you have to have that reference point. This is the most important thing that you need to understand of why, because people say, well, that this stock, was trading at a 52-week low at a low PE. It was in a downtrend and it doubled. Yeah. And that happens all the time. But somebody wins with a pair of twos against aces. Every night at a poker table, everywhere in the world, somebody is beating aces with an inferior hand. But what if you played those hands 1,000 times? Who would you bet on? The guy playing aces and shoving his money in, or the guy shoving in with deuce? And that's the difference. Okay.
That's a golden nugget right there that I often tell people. And what you're going to learn here is exactly that, is how to put yourself in a situation where if you play this out 1,000 times, you're not just ahead, you're way ahead. And one of the things I often say is, look, anybody can get lucky. Nobody stays lucky. And lots of people buy stocks that are down 90%, and they double and they flip them out for a gain. But if you buy, again, stocks that are in stage 4s regularly, or you use bad criteria consistently, your performance is most likely going to be lousy. And the last point I would add is, I think Mark made a really underrated point on the idea of analysts and other folks and listening to people who aren't trading. I'm blown away by the number of people who do listen to stuff off the TV. If these people were so smart, why aren't they trading? Taking advice from those type of folks is highly dangerous in my mind. And look, performance matters. Your track records matter. And you're talking to or learning from two guys who at least have done what they have purported to do in terms of their actual performance. So look, some of these points cannot be understated, and we call them golden tangents sometimes too that Mark goes on, because there's $1 million, or millions of dollars in some of these nuggets if you really internalize them and make them a part of your process and a discipline that you stick to.
Yeah, one of the problems we have now, in the world is that, or in contrast to when I first started trading, there was no information. All right, I had to go to the library. I went to a local library. I read books that were outdated on strategies that never worked in the first place. So it took me a long time to figure this stuff out. I had to figure out a lot on my own. I didn't have charts. There was no internet. There was no online trading. I used to plot charts by hand on graph paper. When I finally got charts, they were weekly, and I would update them throughout the week and draw little lines and have to estimate. I mean, it was, you wouldn't believe what I went through to trade. Had to call in the trades to my broker, wait sometimes 30 minutes for a confirmation. Spreads were $3, $5, $6. Commissions were $170, $250, $300 a trade. And I had $2,000 in my account. So, again, you would think, how could you ever succeed? But I did. I made money. I built on it. I compounded it and turned it into a fortune. And Mark is a similar story, maybe not as archaic as mine, because he started in a more modern time frame. But again, there's so much information out there from self-proclaimed experts that don't have the history, don't have the performance, that you have to now boil it down to and get rid of all the noise. When I didn't have any information, now you have too much information. Just there's so many self-proclaimed experts. I have people all the time. They comment to me on Twitter and tell me how great they are, and I just say simply, well, you can enter the U.S. Investing Championship and prove to the world and put your money up and show everybody that you're better than everybody else. I've done it twice in 24 years, and so I took that risk. Take that risk, go out there and show everybody how great you are. So if they haven't already proven, that's why Mark Ritchie's here. You know, he's got an incredible track record. He's made tens of millions of dollars starting with a small amount of money. He's walked the walk. He stayed consistently dedicated to this type of style and this strategy now for 13 years. That's why he works for me now. He works with me side by side, and he's here today. He's earned it. He's earned it. And I know you guys know most of this, but let me show you. If you the criteria for the trend template, as I call it, or a confirmed stage 2. The cool thing is MarketSmith, of course, our sponsor, they a couple number of years back put trend templates in MarketSmith that I designed with them that are, you know, they're my trend templates, and there's a few of them. On the day that we go over MarketSmith on live trading a day, we'll talk about these, and we'll run the screens and so forth. But I'm just going to show you real quick. There's 4 trend templates. The main trend template is the 5 month, and that's the confirmed stage 2, which 95% of every stock I buy is going to be in that trend template. You can find this if you go. There's actually a shortcut that says Open Stock Ideas, and then from there, I'm tucked in here with Bill O'Neill, which I'm honored to be in the same page with him, and you can find my trend template there. Real quick on the trend template, or on the trend itself, confirmed stage 2 uptrend is when you've got the 200 days in an uptrend for 4 or 5 months, and you've stair-stepped your way higher. The 1 month on there is what we call an early turn, and that's where, and we're going to get into this later on, power plays, where those are stocks that explode very rapidly, and they move so quickly that the 200-day and the trend doesn't get a chance to turn up yet from a period of dormancy. And so that's what we use the 1 month early turn template for. And also it just gives you a heads up. You can see sort of what's starting to turn up, and then live with it for a little while and watch it progress to see if it's improving, and you get a little heads up. Another thing, there's a few caveats to when you're looking at these charts and the trend analysis. When you have very large bases, or bases that had a big decline or several big declines, like here, where you've got Netflix, you came off here, you rallied, you came off again, and now you've had a few good sized declines and you've moved sideways for a long period of time. You can sometimes get where the moving averages flatten out for a period during that basing period, and then when they turn up, it's an early turn. You haven't been in it for very long, but you've put a very large amount of time in with the base, and that I would consider still in a stage 2 uptrend, or a stage 1 that you can buy, when it just turns into that stage 2. Just a few caveats I just wanted to, because over the years we've had some questions about that. Okay, we're going to take another break. This time we're going to take a little bit longer break. I think Bob is going to chime in and let us know here what's happening with that, and then we'll be back. We're talking about fundamentals, and dig a little bit deeper. Again, we have just given you, I want to make sure you understand that we're still in total perspective mode. We have not even gotten to any tools, any real tactics that are for timing or digging deep forensically. We're about to come down to an overhead view, and then we'll move to the aerial and then a microscopic view. But we've been operating from a satellite view. So again, there's been a lot of information here, and you've probably, a lot of light bulbs have gone off, and maybe you've learned some things, but we haven't even scratched the surface. So there's so much more. Stay tuned, and we'll be back. Okay.
All right, guys, that is the stock maturation section. Very detailed, a lot of information. And as Mark Ritchie alluded to earlier, golden nuggets abound throughout the event. Mark has provided the little diagram of a golden nugget there for you. These are the key concepts. Everything is invaluable to learn, but ultimately there are a few points that are really emphasized. That's what the golden nuggets are about. You'll see me sometimes type that into the chat box as well. Can't emphasize those enough. With that said, this is going to be a 15-minute break, and then we'll be back for fundamentals. Let's take that break now.